welcome to The Trade. Before we get to the technicals, a quick look at what traders are watching there. And we are seeing oil prices, US WTI, jumping about 7% to above $93 a barrel. Brent has risen to around 97 after President Trump announced the release of 172 million barrels from the US Strategic Petroleum Reserve. And this follows the IEA's record release of 400 million barrels aimed at easing supply and curbing prices. Oil prices also leaping higher after Iran launched fresh attacks on 3 ships in the Strait of Hormuz, worsening supply disruption fears. Well, of course, analysts saying that it will ultimately be not enough to resolve supply losses from a prolonged war, this IEA recommendation of 400 million barrels of oil. Elsewhere, US consumer prices rising by 0.3% in February to be up 2.4% by the year, led by increases in rents and petrol prices, which have soared 20% since the war began. The US budget deficit narrowed in February to $1 trillion as US tariff revenue slowed, and US Treasury yields have risen after higher oil prices stoked inflation fears and pushed back expectations for Federal Reserve rate cuts. The US 2-year Treasury yield at 3.64, the 10-year at 4.22%. Australian 3-year government bond yields rising to 4.6%, the 10-year just under 5%, with markets now pricing in a 75% chance that the RBA will hike rates by 25 basis points at next week's meeting. Quick look at currencies, with the US dollar index rising, the Aussie dollar holding at 71.3 US cents. Let's get into all the technicals now. And Peter, Brent crude has been on quite a bit of a tear this morning on this breaking news from the US.
So Trump says the war is basically over, but the war is already out of his control. Unless he stops fire first, the war could keep going on while the oil price may keep going up. The IEA's 400 million barrel strategy reserve release may sound substantial, but if Hormuz were fully closed, the daily oil supply would drop by 15 million barrels per day. And if the closure lasts for more than a month, those reserve release would not be enough. So oil price looks like a buy the dip kind of trade. From technical side, Brent crude oil price ran up to 140 and pulled back to 86. That 86 level lined up with the 0.618 Fibonacci retracement, and also act as a support from a previous triangle breakout. So the 83.5 to 86 zone is a decent area to start building a long position in stages. Although there is a strong breakout this morning, the rally probably won't be a straight up like last week. So the trading idea is more likely to be a run trading. If US and Iran talks going nowhere, oil price could get back to 100 within 1 week, or even back to 110 within 1 month.
Well, what about when we look at the gold movement, and particularly the US dollar versus gold, because this is really a story of a lot of momentum in safe haven buying. What are you seeing?
With the war going on, gold and dollar has been moving in a completely opposite direction. At start, people think inflation will be worse, so the dollar went up and the gold went down. But after the job report comes out, the US job report comes out weaker than expected, the dollar dropped and the gold price bounced back. From technical side, the gold price is still moving sideways, stuck between 5,100 to 5,200. If the oil price like today keeps rising, the gold price could get pushed down back to 5,000 to 5,100 area. But since the dollar seems to be struggling to rally after weak job data and inline inflation yesterday, the zone from the chart, the zone around 5,000 to 5,100 seems to be a solid support. So buying around 5,000 to 5,100 is a good strategy with a decent win rate, in my opinion. My first target is the previous high of 5,200 and then 5,400 if it breaks through. But for the gold price to go even higher, there must be some news to hit US dollar harder, like a US stock market crash or more bad US economy data. If that happens, the gold price may hit or even break through the all-time high of 5,600.
All right, and that chart there showing some of the big moves that you were touching on there with the momentum in the gold price. What about, Peter, when we get to equity markets and what we see with tech stocks in particular, and where the technicals we should be watching on the NASDAQ 100 are?
There is a lot of a couple of reasons to be bearish on US tech stocks. The US Iran conflict is one thing, but on top of that, there is a wave of bad news surrounding like private credit sector, and default risks in software sectors are getting more attention. Together, these two factors weigh on Nasdaq 100 index. From technical perspective, the index has been going sideways for roughly 5 months, and the Magnificent Seven has been underperforming, and without fresh capital comes in, further upside looks limited. The key resistance sits at 25,200 with 25,000 just below. This is a solid area to look for short entry. Support is seen at 24,500 to 24,000. But if private credit begins to unravel, the Nasdaq 100 index would break through 24,000 quickly and slide all the way back to 22,000, which would be an attractive level to start building long-term long position.
What about the Aussie dollar, Peter? I mean, even though what we're seeing with the war premium, the Aussie dollar is holding up really well, and the interest rate differential here, right, between what we're seeing globally and further expectations of hikes from the RBA.
The Aussie dollar has been the strongest major currency in the last 2 weeks, mostly because the dollar is weak, and another thing is that people in Australia expected RBA will raise the interest rate next week. The odds has already got to 60% for interest rate hike next week. But we have seen the oil price when the oil price goes up today, Aussie dollar keep going back, and I think the trend will go back to 0.71. But considering the US job data stays soft, I think there is not much space for it to keep dropping. The main trading idea is still buy the dip. But keep in mind, if private credit in United States blows up and the US tech or US SP 500 index crashed, the Aussie dollar will also drop hard and fast. We have seen this happen during tariff shock last April, which is a quick drop followed by a quick recovery. So if that happened, the 0.695 to 0.7 zone offers a good buy opportunity for Aussie dollar. Once the dust settled, the Aussies is likely have further upside ahead.
All right, further upside. That is great news for anybody who wants to travel. And of course, when we look at our terms of trade. Peter, thanks so much, Peter Pan from ACY Securities. That does it for this edition of The Trade. Be sure to join us next time.